Thank you very much, everyone, and thanks for joining this morning's episode of True Potential's Money Markets. In today's video, we would like to discuss the recent price moves that we've seen within oil. Yesterday, we saw the oil price climb to about $90 for Brent, which is the European traded oil market, and about $86 for crude oil, which is the US-based oil market. Now, the reason that we have seen this is from recent decisions from Saudi Arabia to keep oil production lower than what it had previously. So this is roughly about 1 million barrels per day. Markets had been expecting Saudi to keep this continued through to the end of October, but the decision yesterday stated that they're going to continue through to year end. Hence, we saw oil prices actually move higher throughout the day. Now, to provide some more context to how high oil prices have got, if we just go back to the end of June and measure how oil prices have changed within that time frame, they're about 23% higher, and to get back to when crude and Brent were at those prices, we're talking about November 22. So oil prices are certainly elevated compared to recent history. Now, not just oil markets reacted to this decision, we actually saw implications for other asset classes, and that was mainly felt within bond markets. In these videos, we've discussed previous issues that the bond market has faced this year or within the recent past in terms of stronger economic growth, particularly from the United States, then also the increased issuance of bonds coming from developed market governments. Now, oil markets moving higher provides a third factor for bond markets to think about, where market participants are assessing the implications of higher oil prices on future inflation. If we also think about how the bond market, in terms of the different maturity buckets, have reacted to that, we know that short-dated bonds are more influenced by interest rate decisions, whereas the longer maturity bonds are more influenced by growth and inflation expectations. So what we have seen over the recent period during oil's rise is that actually longer-dated bonds have performed worse than shorter dated bonds, i.e. we've seen yields at the longer end of the curve move higher than what we've seen on the short dated bonds. Thank you very much for watching today, and we'll catch you in tomorrow's episode.